Michael Burry has just posted a new video which could expose the US government. The conspiracy includes war, illegal trading, and an already unfolding inflation. Is Michael Burry telling the truth, or is it just the conjecture of his mind with no basis in reality? We will find out in today's video. Hello, and welcome to the channel. Today we will be talking about the explosive new video that Michael Burry claims will show how the government has been lying to you. American physician, hedge fund manager, and investor Michael James Burry. He started the hedge fund Sign Capital, which he led until 2008. Afterwards, he decided to close it to concentrate on his own interests. His most extraordinary claim to fame is that he was one of the first investors to foresee and profit from the subprime mortgage crisis between 2007 and 2010. Now the same Michael predicts that this market will be more bearish than the one we saw in 2008. When he predicted the 2008 housing bubble, he felt that this one would become a more giant monster. On June 1, 2022, the Federal Reserve was scheduled to stop intervening in the economy, but they didn't. That assertion may seem bold, but it is supported by incontestable evidence. The New York Federal Reserve's website contains a list of all the assets that the Federal Reserve is required by law to declare. Fed said on June 1st that they would begin selling $47.5 worth of securities per month. Treasury bonds worth $30 billion and mortgage-backed securities worth $17.5 billion are included in this sale. Michael Burry examined the website and discovered that they weren't offering what they said they were. Instead of selling $30 billion of Treasury bonds, the Fed traded less than $10 billion worth of Treasury bonds in June instead of $30 billion. The Fed brought in a $3 billion value of mortgage-backed securities, rather than selling a $17.5 billion fortune. Right in front of their eyes, the Fed is misleading them. The Fed's holdings were at $8.54 trillion as of July 6. The value of the Fed's holdings as of August 3 was $8.334 trillion. That represents a $20 billion decline, not the $47.5 billion decline that the Fed promised. Furthermore, the U.S. government is hiding the reality that the economy is collapsing. After it seemed like the U.S. economy was going into recession. The term recession has been modified by the White House. A recession is often characterized by 2 consecutive quarters of negative GDP growth. We are currently in a recession since the U.S. GDP growth has decreased for 2 straight quarters. The U.S. government describes the recession as a downturn in the labor market, consumer and corporate spending, industrial production, and incomes in a recent blog post. According to Michael's tweet, the definition of a recession proposed by the White House would exclude certain situations, such as consumers using credit cards to cover inflation or the labor force is insufficient for the size of the economy. According to the White House, real personal income or inflation-adjusted income is a sign of a stable economy. Burry demonstrates that this is insufficient because using credit cards to cover rising costs is growing. The unemployment rate, which is currently still relatively low, was the other number that the White House mentioned. Michael Burry thinks this is misleading because fewer people are entering the labor field. People are retiring or just choosing not to look for work, which causes them to leave the labor force. People who are actively seeking employment are included in the unemployment rate. The workforce participation rate, much lower than before the epidemic, demonstrates this. The number of jobless people is multiplied by the total labor force to determine the unemployment rate. The labor force is shrinking and unemployment is rising. Thus, the unemployment level is artificially lowered. This makes the economy appear more robust than it actually is. Either the White House is uneducated or they are spreading false information. The short-term sentiment was supported by government initiatives. The market has been in a tailspin since the Fed declared it would increase interest rates and begin quantitative tightening. But now, people have started to regain their bullishness. In Burry's opinion, such foolish behavior is a sign that the crisis is far from ending. People's increased optimism suggests that we are merely experiencing a dead cat bounce. Burry refers to the actions of speculative investors as silly when the economy is still in decline. a Hong Kong financial services business called Magic Empire Global just decided to go public on the stock market, and its value increased by over 24 times. This is an example of the same kind of speculative behavior that took place in 1999 and in 2021. Investors are exhibiting the gambler's fallacy because they believe that losses indicate the more tremendous potential for gains. This is currently manifesting itself in equities like Magic Empire Global. Recent data strongly supports this. This behavior was prevalent in the early 2000s dot-com bubble, even during dead cat bounce. In 2001, the S&P declined by 12% before rising by 9%. The S&P has maintained a similar pricing pattern in 2022 as it did in 2001. Given that the underlying economy is contracting and will continue to, such a rebound seems conceivable. The bullwhip effect is causing inventories to increase. A supply chain phenomenon known as the bullwhip effect explains the situation best. It describes how modest changes in demand at the retail level can lead to steadily more considerable changes at the wholesale, distributor, manufacturer, and raw material supplier levels. Part 1 saw valuations decline due to several compressions. This covers ratios like the EV to EBITDA ratio, the price-to-earnings ratio, and the cost-to-sales ratio. According to Burry, the S&P 500 will decline to 25 to 26% in the first half of 2022. The Nasdaq will drop to 34 to 35%, and Bitcoin will decrease to 64 to 65%. There were several compressions there. The contraction of earnings. In reality, Burry's deflationary theory is pessimistic. The Fed's rate cuts result in long-term inflation and lower corporate profits due to falling prices. Michael broke down his argument into two specific components to counter the mainstream media. First, according to him, rising inventories indicate that prices will decline. The mainstream media will oversimplify the short term while simplifying a long time. It won't merely grow or fall in one direction. It will experience cyclical ups and downs with an upward trend. The earnings report is one short-term signal that the media emphasizes. A company's most recent quarter results are reflected in its earnings reports. Companies have done well thus far, according to recent earnings reports. However, most businesses have been forecasting complete disaster for their upcoming quarters. For example, Walmart reportedly downgraded its profit projections for the upcoming quarter in fiscal year 2023. Burry laughed in response to Walmart's earnings. Burry anticipated that starting in July, Walmart and other retailers would see significantly decreased profits. Short-term price reductions may be suitable for inflation, but the Federal Reserve is one factor that is missing. Prices are starting to fall. Thus, the Fed will probably begin to print money again. The same thing took place in 1970. The Fed reduced interest rates after the market meltdown to revive the economy. Short-term market gains were aided by this, but long-term inflation also resulted. This strategy is sometimes referred to as quantitative easing. Unfortunately, Fed's early quantitative easing will result in long-term inflation without their knowledge. Burry thinks the impending inflationary catastrophe will be the worst of its kind in U.S. history. The mother of all bubbles is 2020. Nearly all of the inflationary traits from our previous crisis are present in 2020. We are now living in a post-COVID world. The Federal Reserve has and probably will continue to print billions of dollars. Energy costs are still rising rapidly. The U.S. government is unmistakably preparing the economy for a catastrophic scenario. But that is only the beginning. Behind the scenes, government officials have engaged in frequent insider trading. Politicians have supported businesses in which they hold stock by using government funds. Speaker of the House Nancy Pelosi is a prime example of this. Pelosi has a history of investing in stocks before the government gives them a boost of any kind. Pelosi's recent purchase of semiconductor stocks before the CHIPS bill illustrates this. Another excellent description is when U.S. President Joe Biden sold oil to a company that Hunter Biden had invested in. For a good reason, Burry thinks that more people should pay attention to government officials' insider trading. The Fed's and White House's activities are inconsistent with the U.S. long-term success. But a world conflict would be the hammer that finally sealed the deal. As the Ukraine war rages on and China attempts to seize control of Taiwan, tensions between the East and West are growing. As a result, CEOs in the U.S. are relocating production here in anticipation of a global conflict. Buzzwords of all kinds, such as onshoring, reshoring, and nearshoring, are used to conceal this behavior. Yet, in a Bloomberg examination of earnings call and conference presentations, references to these phrases have increased by 1,000% since the pre-pandemic era. Also, manufacturing construction is at an all-time high, with $94 billion being spent annually on manufacturing structures. A UBS survey of C-suite executives showed that over 90% of executives either had plans or were in the process of removing production from China. 80% of these executives cited the U.S. as their primary location, with Mexico being the second most popular choice. Burry believes that the underlying reason for this is an upcoming world war. The implication of onshoring will be severe. A war would increase the current supply shortage. Well, with that, we are ending it here. Cheers, guys!